The stock market is shattered. Not slightly cracked, not teetering, shattered. And most people are pretending it isn't. Look at the headlines. Markets surge. Investors celebrate new highs. Social feeds explode with charts pointing straight up. But those numbers are illusions. Numbers designed to comfort, to distract, to make you believe everything is fine. Here's the truth. The stock market is no longer a reflection of the economy. It's a machine, fueled by debt, liquidity, and concentrated power. And it's breaking under its own weight. Let's rewind. The market isn't just a place to buy and sell stocks. It's a network, a web of confidence, expectation, and leverage. Every price you see isn't just a number, it's a bet, a prediction, a promise that someone will pay more tomorrow than today. That works fine until it doesn't. Start with debt. Corporate debt is at an all-time high. In the U.S., companies owe more than $11 trillion. That's more than the entire GDP of France stacked twice. Debt isn't just a tool anymore. It became the engine of the market. Companies borrowed to grow, borrowed to buy back stock, borrowed to pay dividends. Borrowing created value, and value depended on borrowing. Then the Fed raised interest rates. Suddenly, that debt isn't free anymore. It's heavy. Interest payments eat profits. Companies that looked strong yesterday are vulnerable today. Some shrink quietly, some crumble openly. Meanwhile, the stock market has become a game dominated by a handful of tech giants. 5 companies, Apple, Microsoft, Amazon, Nvidia, and Tesla, now make up almost 40% of the S&P 500 gains in recent years. The rest, mostly flat. If one stumbles, the illusion of stability collapses. And it's not just debt and concentration. Leverage plays a silent but dangerous role. Hedge funds, ETFs, derivatives, bets on top of bets on top of bets. A single miscalculated option can trigger cascading losses. The system is fragile, yet the headlines pretend it isn't. The irony is thick. The market signals health while the economy struggles. Inflation eats real wages. Housing costs skyrocket. Small businesses close quietly, yet indexes climb. It's as if the market exists in a bubble of perception, separate from the reality most people live in. Let's talk liquidity. Since the last crisis, central banks have flooded markets with money. The Fed's balance sheet has ballooned to over $9 trillion. That money doesn't just sit in vaults. It flows into stocks, bonds, and assets, propping up prices. Every headline about all-time highs is, in part, a story about central banks keeping the machine running. Without that support, many prices would have already collapsed. Now, imagine the system without that cushion. Imagine the moment when investors realize that liquidity is finite. Confidence cracks, margin calls hit, stocks fall in a chain reaction. And this isn't theory. History shows how fast it can happen. In 2008, the collapse started with a few bad bets in a niche market. Within months, the entire system trembled. The stock market is also painfully unequal. Gains are concentrated among the wealthiest 10%. The average investor may feel safe looking at retirement accounts, but growth isn't evenly distributed. Most stocks haven't recovered. Most people aren't sharing in the so-called highs. The market becomes a mirror of wealth concentration rather than economic health. Here's the uncomfortable math. Corporate earnings often appear strong, but only because of cost-cutting, stock buybacks, and cheap debt. Revenue growth is sluggish for most companies. Profit margins are under pressure. The numbers that appear in flashy headlines are often engineered to look good, not to reflect resilience. Then there's the psychology of it all. Investors rely on momentum. Humans chase trends. Fear spreads faster than reason. Optimism can last months, years, decades, but when the mood shifts, losses cascade. The market doesn't fail slowly. It fails suddenly, violently, and unpredictably. And yet, we keep pretending the market is stable because it feels normal. A couple of days of gains, a few surging tech stocks, and suddenly confidence is restored. But it's fragile confidence, built on assumptions that may no longer hold. Let's consider another angle: global interconnections. The U.S. market is tied to the world. Trade deficits, foreign debt, currency swaps, all these invisible threads matter. A shock in one country reverberates worldwide. Remember the 1998 long-term capital management collapse or 2010's flash crash?
Small sparks ignite global firestorms. So what does this mean for the average investor? Or for someone watching the news thinking it's just a correction? It means the system is optimized for growth under conditions that don't exist anymore. Cheap debt, relentless liquidity, and tech-driven dominance created a market that is fragile in disguise. We are living in a paradox. The stock market looks strong on paper. It behaves like it's healthy, but underneath it is brittle. It is dependent on forces that can reverse at any moment. It is concentrated, leveraged, and disconnected from most of the economy. And when the cracks widen, the fallout won't be measured in points. It will be measured in lost jobs, failed companies, and eroded wealth. Here's where it gets even more absurd. Many companies are profitable only on paper. Real-world cash flows can't match the stock valuations. Debt payments loom. Any unexpected slowdown, geopolitical tensions, a sudden spike in interest rates, or a supply chain shock can topple these fragile giants. And yet, media coverage often frames dips as buying opportunities rather than warnings. Look at the cycle. The system feeds on optimism and liquidity. Investors celebrate minor recoveries. Analysts reassure the public. Central banks step in. Stocks rise. Confidence returns. But every intervention pushes risk further down the line. Each fix plants the seeds for a bigger fracture. The market grows, but so does its vulnerability. And then there's human behavior. People act as if past performance guarantees future results. They forget that markets are complex systems, not simple machines. One bad quarter, one policy misstep, one external shock, and the illusion of stability evaporates. Yet society relies on this illusion. Retirement funds, pensions, and trillions in household wealth are tied to stock valuations. The belief in market stability is baked into economic planning. That's why cracks are dangerous, not just for traders or hedge funds, but for everyone. So what's the takeaway? Not panic, not despair, clarity. The market is not a reflection of reality. It's a construct, optimized for growth under artificial conditions. It's fragile, concentrated, and dependent on confidence. And right now, those conditions are being tested quietly, invisibly, while the headlines cheer. The truly unsettling part? Even if nothing collapses tomorrow, the market is a house built on assumptions. Assumptions about debt, liquidity, corporate resilience, and human behavior. Change any of those assumptions slightly, and the system behaves in ways few are prepared for. And that's the question we never answer. If the market is this fragile when everything seems normal, what happens when the next real shock hits? We don't know, and maybe that's the point. Because while charts and indexes suggest security, the reality is far less comforting. Markets are shattered, confidence is borrowed, stability is a story, and the consequences of ignoring that truth, that's the question that lingers long after the final bell.